Good evening and welcome to Wednesday night, Your Money, Your Call. I'm Chris Kimber. Joining me tonight is Ben Clark from TMS Capital and Roger Montgomery from rogermontgomery.com. If you've got a question about shares, our phone lines are open right now. Please give us a call on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. Welcome to the program. Now, Roger, look, I know this is one of your big things you like to talk about, index huggers, people that aren't paying attention to what they're doing. You know, ASX 200, you're holding 200 stocks. You don't want people to hold 5. You know, what do you think? What's the story on that?
Let me just say for the year that's just gone, it's been a very good year.
Yep.
The first half was a lot easier to make money than the second half because pretty much after March, the index has been going down, so we've been investing in a negative market. We started the Montgomery Private Fund, we started investing with some vigour, I guess, around February, and really the market's been declining since then, but we ended up in the fund up about 2.5% for the year,
yep,
whereas the index ended down about 7%
yep,
since for our inception.
So
we're delighted with that performance. It doesn't sound extraordinary. The 6 months prior, 6 months prior, we're talking about returns in excess of 50%. You know,
yep,
a lot of the stocks that we talked about on the program, Matrix, Forge, Decmil, a lot of those companies have gone up an extraordinary amount in the calendar year prior, and particularly in the second half of the year. So this is a lot more difficult, yep, because you've got basically a tide that's going out, and while the tide's going out, it's obviously very hard to find things that are going up. But what it allows us to do is pick up great businesses cheap. Now, on the subject of index hugging,
yep,
most viewers don't index hug. In fact, they go to the opposite extreme,
yes,
where they're probably too concentrated. You know, they've got too much money riding on one stock.
Yeah.
So I prefer to be somewhere in between. I think most of the benefits of diversification are received between 10 and 20 stocks. In fact, between 10 and 15 stocks.
Right.
So, provided the stocks aren't correlated highly, you get a great deal of benefit by adding a second stock to your portfolio, a very high benefit adding the third, and so on. But the benefit diminishes once you go beyond 12, 15, 20 stocks.
Yeah.
You get a lot less benefit and higher costs associated with that. So I don't think index hugging is a concern for most investors here. Mm-hmm. What does concern me is that many investors have their money in industry super funds, which are great because they don't charge much in fees, but if you look at their returns over the last 20, 30 years, you know, they're not much better than money in the bank.
Yeah, well, and a lot of it is in money in the bank, which probably people don't realise. That's great, thanks, that's a good start, boys. We'll go straight to Rob, who's on the line from Melbourne. Hi, Rob, how can we help you?
Oh, g'day, Chris, thanks for taking my call. I've got a question for Ben. What does he think about these steelmakers like One Steel and Blusescope at these levels? And also for Roger, cash converters, does he still like that stock at the moment?
No worries, thanks. There was a stock for you, cash converters, but also if you want to comment on those two,
Look, I don't like the steel companies at all. I haven't. I've written about them many, many times. I think they're hugely capital intensive, largely price takers, you know, massive problems. Blusescope, for example, I've got a value of 99 cents for 2013. It's already trading above that at $1.30, you know, now around $1.30. Cash converters is something a business I know very well.
Yep.
Let me say this, I'll summarise what I think about this particular company this way. The deal with Easy Corp is very, very important for this company. The government has got the daggers out for payday lenders. The company has come out and said that they're not going to be affected by the proposed changes to the legislation. What we're talking about is a green paper that basically says we're going to actually cap interest rates. So some of these payday lenders, what they do is they charge interest rates of up to 400% in a year, and they're proposing to cap those interest rates at 48%. Now the company's come out and responded and said, well, that's not a big concern to us because we've got all these other fees that we charge. You know, they're not interest rates, really, they're other fees. Well, the green paper suggests that those fees are under review as well. So this deal with Easy Corp, where they roll the business model out internationally and it's funded by Easy Corp, that's very, very important to them. If that doesn't work, then I'm very concerned about the long-term prospects for the company in Australia. Having said that, it's a great business from an investor's perspective. Putting aside the social merits of the business and the moral side of it, it's a terrific business on the fundamentals and the economics of the business. Amazing, no doubt about that. And it's not particularly expensive right now, but I'd be very concerned about its long-term prospects, given the government green paper.
And you don't want to be on the receiving end of that collecting bit. Probably, yes,
no.
exactly.
I should add to that. I should add one of the biggest debt collecting companies in Australia has recently made an announcement that they're not going to work for the payday lenders anymore. They're not going to chase their outstandings because they're only collecting about 7%, whereas most of their clients, they collect about 56%.
Right, yeah. Okay, good stuff. Thanks for that, Roger. Let's go to Darren, who's on the line from Melbourne. Hi, Darren. How can we help you?
Hi, how you going?
Good.
I just wanted to ask the panel's thoughts on UGL.
Yep.
I think they're I think it's quite a good company, and the stock's gone down.
Yep.
Just your thoughts, thanks.
Yeah, no worries. Thanks very much for your question. I thought this might come up on your radar. What do you think?
Yeah, well, look, historically, it's actually done the businesses, the management have done a really reasonably good job of adding value to this company over time. What's interesting is, though, since 2006, there's been no improvement in intrinsic value.
Right.
So perhaps unsurprisingly, the share price is about where it was in 2006.
Yeah.
The market capitalisation of the company is higher, but the share price is at the same level. Now, in the next couple of years, intrinsic value may rise for the reasons that Ben's talked about, but it's only rising to where the share price is today.
Yep.
In fact, in 2006, intrinsic value was about $9.18, and at the time was trading about $13. It's now trading about $14 or thereabouts, and intrinsic value hasn't changed. But I've got intrinsic value going to about $13.60 in 2013.
Right.
It's anticipating that now.
So it's still not on your, not close enough. Yeah.
Yeah, look, Woolworths did the same thing. Woolworths has been going sideways since 2007, waiting for intrinsic value to catch up. It's caught up now. UGL's hasn't caught up yet.
I think it's a good answer. We've got Jan from Brisbane on the line. Hi, Jan. What's your question for us tonight?
Yes, hello. I just want to have your views about a stock called ERA. E-R-A-E.
Yep. Yes? No.
And,
yeah.
yes.
Yeah, and look, have you got another one there, or ERA?
Yeah, no, ERA and COK, cock.
No trouble at all. Thank you very much for your question. A couple of different spots there. ERA, you want to... Yep.
Well, I many years ago used to give talks for Westpac Agribusiness around the country and talked about hedging. Spent a long time talking about the advantages of futures contracts versus forward sales. And this is one of the problems. Cotton farmers get into this situation as well, as do wheat farmers, and to a lesser extent wheat farmers. This business, I wouldn't touch it with Ben's barge pole.
That's even further away.
That's toxic.
Only because because not only is there an issue with water in the mine, there's an issue with mine life. There's an issue with hedging now. Previously, it was a good business. It's not anymore. And I've got an intrinsic value of this for ERA of $1.81 and $1.86. It's trading at $4.20 or something.
Yeah.
So,
and if the hedge book's like that, that could be generous.
Well, wait and see.
Yeah, exactly.
Wait and see.
From Sydney, thanks very much for waiting on. What's your question for us tonight?
Hi guys, how are you?
Very well.
Look, I'm ringing about Murchinson Metals, MMX.
Yep.
Just to see, I know they've had their problems, but is it worth getting in at these levels? It did bounce back heaps today.
Yep.
And if you've got a minute or two, Farm Access, BXS. Because a couple of brokers recommended it last Friday on your show as well. So just overall view.
No worries. Thank you very much for your question.
You're talking about it at all.
Oh, we're trying to help Helen out here.
Helen, don't listen to these guys. They don't know what they're talking about.
It was very good for quite a long time.
It was very good until it went down.
Well, unfortunately, we have to go back on the chart, back here, and then there, and then all the way down again.
So
that was the problem.
So you bought it at 90, rode it up to $3.
At $2, yes.
To $2.
Yeah.
You bought it at $2.
No, then bought it back down in about $1.10 on the way back down.
Right.
Unfortunately.
Right. And now it's trading at 50.
Now it's trading at 66 after their partner pulled out. Yes.
Right. Oh, that's disappointing.
So as I said, part of the ride was quite good.
I didn't touch it because my intrinsic value for it is about 4 cents.
Yes. It's still 4 cents. Okay. That's looking a bit rough.
Sorry about that.